Hello and Merry Christmas to you and your family. As this year draws to a close, I welcome you to our two-part year-end special on Investor's Guide. We begin this week by re-looking at the 7 portfolios that have been designed on this show that we've been managing now for 4.5 years. We have the numbers to show you how these portfolios have been performing and to prove that regular, simple and patient investment actually does pay off in any market. Next week, in the second half of our year-enders, we'll pick the top mutual funds to invest in the new year. And of course, none of that would be possible without Kumar. Let me bring him into the show. Thank you so much for joining us and Merry Christmas to you.
And Merry Christmas to you, Faye.
Well, we look at these 7 portfolios now, and are you pleased in any way with what you're seeing in terms of returns across the 7 portfolios?
Looking at these returns, there is nothing in these returns when you have single-digit return, though positive. On a relative basis, technically, we can say that we have reason to be pleased with it. It certainly is a validation of all the principles that we follow. But looking at these returns in isolation, assuming that I had no idea of the market, and when I look at 9% annualized return, I think there is nothing exciting about these numbers. At the same time, there is nothing disappointing when looking at it from a relative standpoint. I think the crucial thing to note here will be that one would have accumulated this much of savings into something meaningful. So, the recurring savings element in these portfolios, I think that is also a crucial aspect.
All right, so before I start talking about these portfolios, I want you to jot down our email ID that's at the bottom of your screen right now. If you have any questions about anything you hear on the show, feel free to write to us. All right, now it's down to business. I'm going to start with our first portfolio. A quick recap, this is our aggressive portfolio. It was designed for someone as young as 25, which means the assumption is you're going to invest regularly right through your working years, and you have at least 30 years on your hands to make these investments. Now, we started this portfolio 4.5 years ago in June 2009, and we've hypothetically been investing 10,000 rupees every month in this portfolio. It's totally given us a return of 9.5% almost over the last 4.5 years. I'm going to give you a recap of the funds in this portfolio as Dhirendra recommended: the DSP BlackRock Short Term, IDFC Premier Equity Plan A, Quantum Long-Term Equity, SBI Emerging Business, UTI Opportunities. Now, we've invested 5.5 lakh rupees and we've made a profit of about 1,15,000 rupees on this portfolio so far. Like we were talking about, Dhirendra, now on its own it might not seem like a great profit, but if we look at the market over the last 4 years, the ups and downs and the heartache that it's caused investors, this is an impressive aggressive portfolio.
Yes, but eventually, when you look at the pure arithmetic of it, it is 9% annualized return. I think the consolation one can derive is that this is an aggressive portfolio. It has a sizable allocation to mid and small cap stocks. It also has, 10% allocation to fixed income all the time. So in one sense, our most aggressive bet is also following a set of principles. And it is built on 5 funds. With a fairly well articulated mandate, so reason to be happy. At the same time, single-digit return, much more to be expected. And I think these portfolios will really come to deliver things in life. Because when I look at inflation, what it has been over the last 4 or 5 years, we have reason to be very disappointed with these returns. 9% return from after assuming so much of risk. But yes, this has also been the most troublesome time for the market. And I think one upturn, this portfolio has not, on any of our portfolio over the last 4.5 years, hasn't seen any market upturn.
All right, so we're waiting for a market upturn, and this will teach us basically to be patient with our investments. Remember, with an aggressive portfolio like this one, we haven't lost any money and we have made a profit. I'm going to give you a recap of that aggressive portfolio. There's the DSP BlackRock Short Term Fund, the IDFC Premier Equity, Quantum Long-Term Equity, SBI Magnum Emerging Business and UTI Opportunities. Let's move on to our next portfolio. This is our growth portfolio designed for someone who's 35 years old. It steps back ever so slightly on the aggression, but it's still meant to give you strong returns. These are the funds in this portfolio: the FT India Dynamic PE Ratio, the HDFC Midcap Opportunities, the ICICI Prudential Discovery, the Quantum Long-Term Equity, UTI Dividend Yield. Dhirendra, would you like to make any changes in this portfolio? It has given us a return of nearly 9%, but do you think there are some funds there that you'd like to switch over?
Yes, I would like to, simplify this portfolio a little bit, and also based on the kind of performance that has been derived from other kind of funds, and ensuring our basic principle that reduce the number and ensure the diversity of a style across also the approach of various fund managers. And this being a growth portfolio, all that we ensure is that it does not get into the very venturesome component of it should not have a large component of small and mid caps. At the same time, 20% allocation to fixed income, that is being derived in a fairly dynamic way with the Franklin Templeton Dynamic P ratio fund, and it has worked out very nicely in all the allocation where we have this flexible component, because the 20% allocation, this is the long-term portfolio. At the same time, we want this allocation to fixed income at least in the region of not less than 15-17% and not go exceeding 25%, and that is something which is managed very nicely with this fund. So the fixed income or the stability, the component which derives stability in this portfolio is achieved with this fund. I would like to substitute the ICICI Prudential Dynamic Fund, the Discovery Fund with the ICICI Prudential Dynamic Fund. I find this fund to be a little more conservative, and tactically this fund reorients compared to the Discovery Fund, which right now is heavily, it's a value fund. It's heavily into small and mid caps, and sometimes it can be a test of patience. So that fund is a compromise on stability, which can be derived from this dynamic fund. Likewise, I would like to have Templeton India Equity Income Fund as part of this portfolio.
All right, so that's our growth portfolio. Remember, it's given us 9.29% returns over the last 4.5 years. I'm going to give you a recap of the portfolio as it stands. FT India Dynamic P Ratio Fund, the ICICI Prudential Dynamic Fund, Quantum Long-Term Equity, the Templeton India Equity Income, and UTI Equity. We have another portfolio I'd like to look at in this segment, and that is our international portfolio. It was started on the 1st of July 2011, which means that it's about a year and a half old, but it's given us returns of 21.5% since then. And these are the funds in that portfolio: the Birla Sun Life International Fund, the Motilal Oswal Most Shares Nasdaq 100, the Principal Global Opportunities, and Sundaram Global Advantage. Now, we invested about 3.8 lakh rupees in this fund, in this portfolio a year and a half ago. It's currently at 5.4 lakh rupees. So we've made that much of a profit in a year and a half. Dhirendra, that's really impressive, but it is an aggressive investment, isn't it?
It might look aggressive, but it is not, because your money is so beautifully, is invested across the world, and that was the goal with this portfolio: go beyond India. And that has come in handy, that very approach that one should diversify, and true diversification or should also mean investing beyond our home market. So at least have a part of your money which is not entirely dependent on India or Indian performance. So from that standpoint, it has come to life, and it has been a big beneficiary of the rupee depreciation, which I think is not a replicable instance. It's not an event which will occur at a defined periodicity. Yes, over a period of time, rupee will depreciate, given the interest rate differential we have in many economies and India. But I don't think it will repeat very often. So this is a one-time benefit that has accrued to this portfolio. But otherwise, I feel that I'll be very happy with just 2/3 of these returns being achieved with such a portfolio.
All right, so we had a lucky streak there with our international portfolio, but we're going to continue to calmly invest 10,000 rupees a month in this portfolio. A quick recap of the funds in our international portfolio: the Birla Sun Life International Equity Plan, Motilal Oswal's Most Shares Nasdaq 100, that's an ETF, Principal Global Opportunities, and Sundaram Global Advantage. Dhirendra, they're not making any changes in our international portfolio. Time for a very quick break. When we come back, we'll discuss a portfolio designed for a 45-year-old and a 55-year-old. Stay tuned.